wealth and consumption. Okay, so wealth and consumption seem to move more closely together. Yeah, visually. But of course, from a theoretical point of view, it's hard to believe that income should not be relevant, right? So, okay, so what would you do in such a case? Okay, this is deviation from the consumption function. So the first thing to do, we have more than two variables. You cannot just look at the deviation, right? We should also know what are the coefficients of income and wealth. So consumption depends on income and wealth. What is the coefficient of income? The marginal propensity to consume. We don't know, right? So we have to estimate it. The marginal propensities to consume out of income and wealth. So what you do is you estimate a consumption function, okay? So consumption as a function of income and wealth. And then the deviation is the residual from this estimated consumption function. Okay? So that's what we saw in the graph, was this estimated value of UT. Okay. So that's over here. The question arises, is this stationary or does this have a unit root? Okay. Again, if we compare with the previous case, this definitely looks highly stationary. But this one, you can see there could be large deviations from the mean, and the deviations can be quite persistent. They could last for several years. So it's not so obvious whether consumption is co-integrated with income and wealth. And if it's not, if they are not co-integrated, it means there is no no stable consumption function exists. Okay? So all the theories, permanent income hypothesis, consumption smoothing, all those things can be rejected if there is no co-integration between these variables. Okay, so, well, the deviation looks much more stable than consumption, income, and wealth themselves, suggesting that this vector, this may be a co-integrating vector, one minus of this and minus of this, but whether it is actually stationary or not, whether this is stationary or not, that is something we have to test, and we will learn how to do that in some minutes. Okay. Another application of co-integration is with estimating money demand. Okay, whether there exists a stable money demand function. Okay, very important for setting monetary policy to know, does there exist a stable function for money demand? Okay, so how could we test that using co-integration? Okay, so let MT represent nominal money. So if you divide that by the price level, then you have real money demand. And let small m to denote log of real money demand. So it's log of the nominal money demand scaled by the price level. So this is log of real money demand. So what does MT depend on? From a theoretical point of view, how much money consumers want to hold in real terms? What does that depend on? It depends on interest rate, okay? But there are many kinds of interest rate. Right? So some are short-term rates, some are long-term rates. Which one are we talking about? The interest rate, one big variable, definitely. What any other variable? How much money households want to hold depends on the interest rate, and what else? Studied this, right? Last semester? Macro? Basic macro. Money demand depends on inflation. No. We are scaling it by the price level. So this is real money demand. Price. No, price is already reflected. Right? Real money demand. That means the amount of money you want to hold in real terms, the purchasing power that you want to hold, that's small, that's M, right? Small m. Interest rates, and what else? Income, right? Income. As your income increases, your expenditure increases, you want to hold more, higher real balance. So income. So let small y denote the log of real GDP. So big Y is real GDP. So depends on income and depends on the interest rate. Now interest rates, there are many kinds, but let us distinguish between two. So BT is the bond rate. Think of this as a long-term interest rate. Right? Bond has a 10-year maturity, so it's a 10-year interest rate. And RT is a short-term interest rate. So that's the interest rate you get in your savings account. Okay? So it depends on income, it depends on the long-term rate and the short-term rate. And what are the signs of these variables that we expect? Well, if YT increases, real income increases, we expect MT to increase. So we expect this to be positive. And then if BT increases, we expect MT to decrease, right? So if the interest rate on long-term asset like this bond goes up, then if you hold money in your savings account, you're only earning, you're giving up the opportunity to earn a higher return in the bond market. So if the interest rate on the long-term bonds goes up, you want to reduce your holdings in your savings account and buy a bond instead. Okay, so negative. And if the interest rate in your savings account goes up, then MT should go up or down? Up. Okay, so MT really, so BT minus RT, really the difference between the long rate and the short rate is the opportunity cost of holding money. That's the interest rate you give up when you hold cash, because you could be holding a bond and that would give you extra return, BT minus RT. Okay, so if you look at some theories of money demand, the standard kinds of theories, then you get some equation like this. Okay, so positively and with a unit coefficient on GDP or income, and then some negative coefficient W on the opportunity cost of holding money. So now, what are the variables that we have? Our XT, we have MT, YT, BT, and RT. So these are the four variables that we have. And economic theory tells us that there should be a money demand function that looks something like this. Okay, depends on positively on income, negatively on the opportunity cost of money. So what is the co-integration vector that is associated with X? Okay. So individually, these variables are non-stationary, but their linear combination should be stationary if there is a stable money demand function. So how can we test that? What is the co-integration vector that is implied here? So to get the co-integration vector, we bring all the variables to the left-hand side, to one side, then you have MT minus YT plus W times BT minus RT. So that tells us that beta prime is going to be 1 minus 1 W minus W. So the coefficients from here. Okay, so that is something that we can test. Are these four variables co-integrated with each other with this as the co-integration vector? If yes, then it means there exists a stable money demand function. If they are not co-integrated, then there's no stable money demand function. Okay, so I will give you some data and then you can test this out. Okay, now this example is also important because it tells us, so this, we have this kind of money demand function, and we could test whether we observe co-integration and whether this is the co-integrating vector. But this example is important because it also illustrates the possibility that the cointegration vector may not be unique. There could be more than one. Okay? So for example, alternatively, theories for the determination of interest rates would suggest that two interest rates with different maturities should be co-integrated. So here we have a long-term rate and a short-term rate, BT and RT, okay? And they should be, according to some models, the interest rates themselves could be co-integrated with each other, okay? So for example, the term structure theory of interest rates it kind of implies that long-term rates and short-term rates, they are not independent of each other. They are connected to each other. And in particular, you could get another cointegration vector because BT and RT are cointegrated with each other. Okay? So what is the term structure theory? What does it tell? What does it say? The relationship between long-term and short-term rates. Have you learned this before? Term structure theory? No? Very briefly.
金融市场有3个，对吧？ Term structure， 什么 default， term structure， 叫什么 issue structure， 时间越长，然后利率越高。
Okay, so the key idea is, as you change the term of the bond, right? You start from short-term bonds, 1 year to 2 years to 3 years to 10 years to 30 years. What kind of structure should you get for the interest rates by changing the maturity? Okay. Now, when we are changing the maturity, it's important to keep other factors constant, like the default risk of the bonds. Okay, that should be held constant. We change the maturity, holding constant the default risk. Okay, so what does that mean? So that means the issuer of the bond needs to be the same for the default risk to be the same. So we're not going to compare, 1-year bond issued by the U.S. government with a 30-year bond issued by Apple. Okay, by the company Apple. So because the default risk is different for these two issuing agencies. Keeping constant the default risk, we change the maturity and see what kind of structure there is. Okay, so suppose IT is the interest rate on a 1-year bond. I2T, so interest rate on the 1-year bond today. So that's the current interest rate. I2T, interest rate on a 2-year bond today. INT is the interest rate on an N-year bond today. Okay, so we want to see the relationship between these bonds, between these interest rates. Now, to keep things simple, let's just work with a two-period bond. Okay, so suppose you have $1 to invest. First, so you have $1 to invest for 2 years. So 2 years is your investment horizon. You could invest for n years. It can be generalized. $1 to invest for 2 years. So what could you do? You could buy a 2-year bond today, which will mature at time t plus 2. So if you buy a 2-year bond today, you buy a 2-year bond, how much will you have at the end of 2 years? I2T is the interest rate on the 2-year bond. So you buy $1 worth of the 2-year bond. After 2 years, what do you have? 1 plus I2T. One times 1 plus I2T. So that's 1 plus I2T. Square. Okay, that's the important part. Okay? So we invest this for 2 periods, you end up with 1 plus I2T squared. Okay? So the interest that you earned, 1 plus I2T squared minus 1. $1 is your original investment. Okay, so that's the amount that you earned is this. So this is 1 plus I2T squared plus 2I2T minus 1. Now, of course, the 1 and the minus 1 will cancel out. Now, I2T square. Now, interest rates are small numbers, right? So, 1%. If I2T is 1%, its square is going to be 0.0001. So that's a really small number. So we can ignore that. So this is approximately 0. So we can forget about this as well. So the interest that you earn, it's approximately 2 times I2T. Now, instead of buying a 2-year bond, how else could you have invested your dollar for 2 years? What other choice do you have as an investor? If you don't want to buy a 2-year bond, you could buy a 1-year bond, right? Very good. So you buy a 1-year bond. Now, but you want to invest this dollar for 2 years. So if you buy a 1-year bond, after 1 year, how much do you have? So over the first year, you earn interest IT. IT is the 1-year interest rate. So at time t plus 1, you end up with 1 plus IT. Now what do? Because your investment horizon is 2 years. For the first year, you got interest IT. For the second year, what will you get? For the second year, what interest will you get? Also the square. So you're saying the interest rate will be IT for the second period as well? Yeah, the interest rate on the 1-year bond for the next year. How much is that? Do we know that at time t today? We don't know. What's the 1-year rate after 1 year? We don't know that. But we have some expectation. So the interest rate here will be the 1-year rate at time t plus 1, which we don't know today at time t, so we have an expected value. So this is the 1-year interest rate 1 year from now. That's what you will earn in the second period. Okay? So what you end up with, 1 plus IT times 1 plus IT plus 1E. So the interest that you earn is this minus your original investment, and if we multiply this out, once again the ones cancel out. IT times IT plus 1E. Well, this again, the product of two interest rate terms, so approximately 0. So this will be approximately IT plus IT plus 1E. So in the first case, the interest earned is approximately 2 times I2T. In the second case, IT plus 1E. In equilibrium, what should be the case? They should be the same. Whether you buy 1 2-year bond or 2 1-year bonds, right? You should earn the same amount. So that tells us that the 2-year rate should be an average. Okay, of course I am just making this really simple. I'm abstracting from a lot of things. Okay, for example, we are assuming that people here are risk neutral. Okay, because the I2T you get with certainty, right? The 2-year bond, you observe the rate today. But here, there is an expected value, which may or may not be realized. But if most investors are risk neutral, then these two should be approximately the same. Okay? You can modify it, make it more realistic by adding a risk premium. That can be done. Okay? So what this is telling us is that the 2-year rate is an average of the 1-year rate today and the expected 1-year rate 1 year from now. Okay? So we could generalize this to the n-year rate. So the n-year rate is going to be a weighted average of today's 1-year rate and the expected 1-year rates over the next n years, or the next n minus 1 years. Okay, so that's today's long-term rate basically reflects expectations of the path of the short-term rates over the next n years. Okay, that's what this is telling us. Now, this formula may not exactly hold because of risk premium and other considerations, but if people are risk neutral, something like this will approximately hold in the bond market, and that is the term structure. So this is saying that the short-term rate today will be co-integrated with the long-term rate, provided these expectations are stable, they are not too volatile. Then the short-term and long-term rates will be linked together. Now, when you observe, so that's why, okay, so when we draw a picture of these curves, so suppose I have time here, and I have the interest rate here. Okay, so if I were to draw a picture of the interest rate by varying the maturity of the bond, what kind of picture would I get? What should it look like? So should it be flat, upward sloping, downward sloping? What kind of shape? It should have upward sloping. Okay, so if so this is an upward sloping yield curve. Upward sloping yield curve. How can I interpret this? If you have an upward sloping yield curve, what is that telling us? What can we infer from an upward sloping yield curve? Very good. So what we can infer from this is that the future short-term rates are expected to go up. Okay, so it is predicting what these future rates, IT plus 1, IT plus 2, IT plus n minus 1, they are likely to go up. Okay, if you observe an upward sloping yield curve. So what does that mean? Well, that means the central bank is tightening monetary policy. Okay, you expect the central bank to tighten monetary policy. They are going to raise rates, the short-term rates. So why would they tighten monetary policy? Because there must be a threat of inflation. So that means the market is predicting that the next few years growth will be very rapid and there could be a threat of inflation. So central banks are going to raise rates. That's what the market is predicting about the future. And if you observe downward sloping yield curve, what does that tell us about the future? And so that's telling us the opposite. So it's telling us these future short-term rates are likely to go down. And why would the central bank try to lower the future short-term rates? Is because the economy is likely to enter a recession. Okay, recession. So downward sloping yield curves, they forecast recessions. One of the best, the best predictor for a recession is a downward sloping yield curve. So you observe a downward sloping yield curve, chances are very high that in the next 1 to 2 years, the economy is going to enter a recession. So what does the yield curve look like now? Downward sloping already? Let's see. Google a little bit, you can see the Treasury or the yield curve on US Treasury bonds. So that's the most recent one, or maybe this is the most recent one. But let's just look at this because it's easier to see. So these are the maturities, 1 month, 2 month, and so on. So you can see roughly constant, going up to 1 year, it's flat or going up. Then 2 years to 5 to 7 years, slightly inverted over here. Right, from 2.6, it's going down. And then for the long term, it's rising up again. Okay, so not fully inverted yet, okay? But investors watch very closely the shape of the yield curve to understand the risk of recession, okay? So if this were to completely invert, then you would see huge movements in the stock market and in the bond market. Okay, so if the term structure theory of interest rates holds, then that tells us that two interest rates with different maturities should be co-integrated. So the long-term rate and the short-term rate, they will be co-integrated. So another possible co-integrating vector would therefore be based on that relationship between BT and RT, 1 and minus 1, whereas M and Y, their weights are now 0, 0. Because it's the long-term rate and the short-term rate that are co-integrated with each other. M and Y have nothing to do with that. Okay? So that tells us that for these four variables, another possible co-integrating vector, 0, 0, minus 1, and 1. Okay? Now, there is a third theory which is related to the velocity of money. Okay, so there's possibly a third co-integrating vector here. So this third vector arises from the quantity theory of money. So what's the quantity theory of money? Okay, quantity theory of money, famous theory. Milton Friedman was a big fan of the quantity theory. So V is the velocity of money. It's the speed at which a dollar circulates in the economy. Right? So velocity is 2. That means each dollar is used twice within a year on some expenditure is used. P is the price level. Y is real GDP. And M is the nominal, the dollar amount of money. Okay, so M is the quantity of money, the number of dollars in the economy. Y is the real output that is produced. P is the price level. So P times Y, that is the nominal GDP. Now every year we have M dollars and we use them to buy the whole GDP of the country. So each dollar is used V times in purchasing the nominal GDP. So M times V should equal P times Y. Okay? The total amount of spending, this is the total number of dollars we have, and this is the number of times we spend each dollar that there is. So okay, so how does it relate to what we are doing? Well, we can rewrite this. And then we take logs. And this is real money, M over P in logs. So that small m, and let's call this small v the log of velocity, and Y is log of the real GDP. So now QTM, the quantity theory of money, assumes that the velocity of money V is okay. The velocity of money is roughly constant. So what that means for us, we interpret that the velocity of money is stationary. Okay? So if V is stationary, V is I0, well, that implies that M minus Y, if we look at the linear combination of real money and real GDP, this should also be stationary. Okay, so that means we have another co-integration vector with a weight of 1 on M, minus 1 on GDP, 0, 0 on the two interest rate variables. Okay, so that's another possible co-integration vector that arises from the quantity theory of money, which says that the velocity is stationary. Now, 3 possible co-integration vectors. Which one exists in the real world, okay, if any? So that is an empirical question. Which of the 3 scenarios do we have a stable money demand function? Are long-term and short-term rates co-integrated with each other as the term structure theory implies? Is the velocity of money stationary, as the quantity theory implies? Okay. They are empirical questions, and we will learn how to answer these questions. Okay, let's take a break now, so 15 minutes.